Hello and welcome to First Look ETF. I'm Stephanie Stanton with ETF Guide. It is great to have you with us. Coming up on our June edition, we'll explore a trio of new ETFs that slice and dice the bond market by credit ratings and a new fund designed to tackle high inflation and low economic growth, plus an actively managed ETF that targets companies with strong long-term growth prospects. But first, we begin with a recap of the newest ETF launches on the New York Stock Exchange. Joining us now is Douglas Yones, live from the NYSE. Hi, Douglas. It's good to see you.
Hi, Stephanie. It's great to be here.
All right, let's talk about the latest update on launch activity that you're seeing for ETFs.
Yeah, last month, we're continuing the trend. Regardless of market conditions, the ETF market, the ETF universe continues to grow. We had 26 new ETFs launched last month, raising over $10.5 billion. So the trend of growth is certainly here. And again, many new, unique, and innovative ETFs coming to the market, hence your upcoming guests on this show.
Yeah, absolutely. I know it's kind of crazy. The market's sort of been up and down, but what other trends are you guys seeing in the ETF marketplace right now?
Yeah, again, regardless of market conditions here at the New York Stock Exchange, 174 ETFs have launched this year, raising close to $19 billion in new cash flow. We're seeing a lot of unique trends. We've still got the active ETF growing. We still got a lot of really unique and interesting ETFs, particularly focused on the trends we're seeing in the marketplace. Those are inflation trends. Those are the fixed income trends. And as you mentioned, upcoming, right, a new and unique focus on slicing and dicing the fixed income universe. This year, a lot of people don't realize, is the 20th year anniversary of the very first bond ETF that launched here at the New York Stock Exchange. And so innovation in our space around bond ETFs, a lot of investors, a lot of advisors, they're looking for new ways to go into fixed income ETFs. They're looking for different ends of the curve. They're looking for, a little less aggregate and a lot more micro. And so we're seeing a lot of ETFs come to the market that really offer new ways of investing, all using ETFs here at the New York Stock Exchange.
All right. Well, people have to get creative, right? Thank you, Douglas. It is great to see you. Very impressive.
Thanks, Stephanie. I'll talk to you soon.
And a quick reminder that we simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms, so be sure to check us out there. The U.S. bond market is having a rough year, leaving some fixed income investors scrambling for alternatives. Well, here to discuss a new group of bond ETFs with a radically different approach is Joanna Gallegos, a co-founder at BondBloxx. Hi, Joanna. It is great to have you with us.
Hi, thanks for having me.
So BondBloxx offers a unique approach to bond market investing. Can you first give us a big picture view of what you're doing and why it's different?
Yeah, what's different about BondBloxx is we are dedicated to the bond investor. And so what that means is we're very driven to solve problems that the bond investor has in terms of how they access fixed income markets, either to build their portfolios or manage a book of risk. So unlike most ETF issuers, we're 100% focused on fixed income. And I think that's a little unique because, most providers do more than just one type of ETF. But what we kind of been harnessing is our experience over 20 years in building ETFs, and specifically in fixed income. We hear two things from clients over and over again. And that is that they're looking to build very tailored long-term exposures in fixed income, but they also need an ability to tactically put on or take off components of that exposure. And so what we see out there, our observation, and I think why our intention is a little bit different, is that the current product offering doesn't really solve those two problems for investors today. In fact, there just isn't the same sophisticated approach in product granularity that these investors need in order to complement what they're doing on a day-to-day basis, which is investing, directly in cash bonds, but also using portfolio trading. So we're here to change that, and we're here to have the ETF live very well side by side with those two other methodologies of accessing the fixed income markets, and give investors, the full toolkit that they need to deliver like a very precise portfolio or manage risk very in particular.
Okay, so with that being said, you guys have three ETFs that you are offering. Tell us more about these funds and how they work.
Yeah, the most recent launches that we had were three credit ratings funds, and they're very simple, intuitive products. They are pure play components of broad U.S. high yield exposure. They allow an investor to invest with a lot more precision in high yield fixed income, and they also reflect the way that we're hearing from clients that they already invest, which is specifically managing their credit rating positions. And so they are across B, triple B, double B, and triple C. And now they're available in ETF, which provides them the same simple way to trade a bigger basket of fixed income. And they provide, time-tested liquidity and reliability and efficiency in an ETF wrapper.
So given the current state of affairs right now with markets, how do you then see BondBloxx ETFs being used by investors as part of an overall portfolio?
Yeah, we hear from investors often that they are very frustrated with the current offering in fixed income ETFs. And our products have many use cases, but they're basically for any investor that has a relative view in fixed income and wants to express it in a more granular way. And we are going to be launching products that reflect the specific characteristics in fixed income that bond investors care about. So we think that our approach is going to give investors a lot more flexibility, especially in the markets of today, to build their portfolios.
Joanna, thank you so much for joining us today here on First Look ETF.
Thank you for having me.
Stagflation. It is a dreaded word, and some economists believe the global economy is headed toward it, a slow growth cycle coupled with continued consumer inflation. Well, investors may be seeking assets that can perform well during this type of challenging economic backdrop. Joining us to discuss this and more is Axel Merk, President and Chief Investment Officer with Merk Investments. Hi, Axel. It is great to have you with us.
Great to be with you, Stephanie.
Okay, before we dive into your new ETF, give us some background on stagflation. How would you define it, and do you see economic stagflation ahead?
Well, the plain definition is really weak economic growth with inflation, but that's not given it sufficient credit, I think. Supply shocks are stagflationary. You have a pandemic, you can't produce anything anymore, and so that's the sort of thing that creates inflation. But the real thing that causes stagflation is a supply shock with a policy mistake, because the quote-unquote correct reaction to stagflation is political suicide. Instead, what you do is you give $1 trillion stimulus, and so you're stimulating demand when you don't have enough supply. And that's but one of many things. The 1970s, of course, we had price controls to fix the problem, exacerbating them. And so it's the dynamics that are unleashed from a supply shock that tend to be stagflationary. And recently, the World Bank issued a long report that's really an advertising pitch for our ETF, it seems, of all the potential things that might happen going forward.
So the Merk Stagflation ETF, your ticker is STGF, that has just been added to your product lineup. Tell us a little bit more about the fund's strategy and some of its top holdings.
The Merk Stagflation ETF provides exposure to investments that are expected to benefit from persistent high inflation in an environment of potentially weak growth. And specifically, we invest in gold, oil, real estate, and inflation-protected securities. We have a core holding in TIPS. And then we have a proprietary rebalancing methodology that's a trend following methodology that provides the weights in oil, real estate, and in gold. And the reason we chose the trend following methodology is that particular methodology worked very well in the 1970s. Now, obviously, we're not exactly in the 1970s environment, but as a starting point, we looked at things that perform well when inflation expectations go up, and then we narrowed it down to things that we can communicate with. And so those are the holdings we have.
Yeah, and obviously with investors looking for safe havens for their money, how do you see an ETF like STGF being used by investors and financial advisors as part of an overall portfolio?
We think that advisors may put it into their fixed income allocation. Ideally, you would like to invest in the CPI. That's the one thing that worked well in the 70s and in a stagflation environment when both bonds and stocks don't perform so well. Now, obviously, you cannot invest in the CPI index, but if you look at at the index that we invested in, obviously there's a new ETF, and we can't say we'll do whatever might have happened in the 70s, but the idea is to have something that will correlate well with that sort of environment. And we do think that with the stagflation ETF, we've kind of squared the circle to have a product that may work well in a stagflation environment, is an easy plug-in as an alternative to a fixed income allocation. And we do see some people use it for an equity allocation simply to be more on the defensive side, and have less of or no equity exposure for that matter.
And obviously you guys launching this now due to the current economic environment. Looking long range, I mean, do you see any relief from these stagflation, inflationary conditions?
That's a very good question, because some people say, oh, inflation spiked, it's going to go down. Well, Bernanke, the former Fed chair, just wrote a book, and he said if we had 8% inflation every year, it would be inconvenient, but we could plan for it. The problem with higher inflation is that it is not constant. It's going to be volatile. And so just imagine what's happening right now, right? Federal Reserve is hiking rates. Then they're going to take a pause. Inflation might tip down. They say, okay, victory, we've solved it. But sure enough, inflation's going to go up again. Janet Yellen just said, well, they have to revise inflation expectations higher for this year. We're not going to have 2% inflation quite possibly for several years. So this is not a product for a few months. This is something because that might last a while. That's the problem with inflation. And in the 70s, lasted over a decade. And part of the reason it lasts so long is because doing the quote-unquote right thing is so very, very difficult. And the politically attractive thing will exacerbate the problems and continue to this instability that we've been seeing in the markets.
All right, fasten your seatbelts. Axel, Merk, thank you so much for joining us here on First Look ETF. It's great to have you with us.
My pleasure.
Popular index benchmarks linked to large cap growth stocks can sometimes hold hundreds or even thousands of stocks. But for some investors, bigger isn't always better. Some financial advisors may be looking for a more selective and analytic strategy when deciding which stocks should stay in their portfolio. Well, joining us to discuss a new actively managed ETF with a more targeted approach is Spencer Logan with Harbor Capital. Hi, Spencer. It is great to see you again.
Hi, Stephanie. Great to be back with you.
So the Harbor Long-Term Growers ETF, the ticker WINN, W-I-N-N, has just joined your ETF lineup, and the fund is categorized as a large cap growth equity fund. How does the fund compare versus some of its peers?
Well, I would begin with focusing on the team at Jennison that actively manages WINN. The award-winning, highly regarded large cap growth team currently oversees more than $100 billion in assets under management and brings a 50-year plus track record of success to the Harbor Long-Term Growers ETF. So with the launch of WINN, investors now have a real access to the long-standing investing philosophy of that large cap growth team, and that comes via a fully transparent, actively managed ETF, bringing the benefits of enhanced liquidity and improved tax efficiency to an already great strategy.
So obviously you've got a lot of experience behind it. What are some of the industry sectors and companies that WINN is targeting for high growth opportunities?
That was a good question, especially in today's environment. And the investment team's fundamental research, Stephanie, it really seeks to identify mid and large capitalization companies it believes will have both a magnitude and a duration of growth that's above that of the market. So these companies typically possess a combination of characteristics such as they have a market-leading position in core business areas, they employ a disruptive business model, they should possess above average revenue, earnings growth, cash flow growth over the next several years, and have appropriate valuations relative to the long-term growth potential, and do all that with an experienced management team that can execute. So with that, companies like Microsoft, Apple, and Alphabet, they tend to take up the top 3 spots currently, and they've been long-time holdings for years, and as they benefited other parts of Jennison's large cap growth portfolio, if you will. But outside of technology, luxury goods names such as Louis Vuitton, Lululemon Athletica, and Nike have really captured the team's attention as businesses offering unique business models that will have sustainable competitive advantages that will continue to drive long-term growth.
So with that being said, how do you see this ETF being used inside a diversified portfolio?
The ultimate question, right? And so given the market shifts and really the macroeconomic developments, investors are now increasingly weighing asset allocation and manager decisions within the large cap growth space with a very, very acute eye. So despite elevated volatility, today's environment likely enables long-term investment in higher growth stocks at much more attractive valuations with a potentially more favorable future backdrop of that decelerating economic growth you're starting to hear a lot about. So as such, we really believe that actively managed Harbor Long-Term Growers ETF, which is ticker symbol WINN, that's sub-advised by Jennison's seasoned large cap growth investment team, really warrants increased investor attention as the large cap growth component of any well-diversified portfolio.
All right. Well, we'll have to see if WINN is a winner on Wall Street, right?
That's right.
So I did that.
Love it, Stephanie.
All right. Spencer, thank you so much for stopping by. It's always good to see you.
Always great to be here, Stephanie. Thank you very much.
All right. Well, that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. We want to give a big thanks to all of our guests, along with Douglas Yones from the New York Stock Exchange. Be sure to check out homeofetfs.com to learn more. And also, don't forget to pick up the podcast version of First Look ETF. It is available on iTunes, Spotify, Amazon Music, and other major podcasting platforms. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.